Welcome, everyone. It's Angelo Robles, host of the Angelo Robles podcast and the founder and CEO at Family Office Association. Really special guest on today. I've been a fan for several years on Twitter. I finally worked up the courage to reach out to him. He's very witty, so I didn't want him to embarrass me in the interview. I had to prepare. Our special guest today is Jared Dillian. He's the editor at Daily Dirt Nap. Of course, one of the greatest subscription newsletter titles ever. On that alone, you all should go and subscribe. He's a two-time author, a Bloomberg opinion columnist. And again, I highly recommend his Twitter follow, which is Daily Dirt Nap. Jared, welcome to the show.
Hey, thanks for having me.
A pleasure. Lots to talk about, from inflation to interest rates to where family offices and investors may want to look to invest. But I'm going to start off really serious and the most important question. You actually had the nerve, Jared, to say that the New York Yankees may not even reach 500 this year. Were you saying that to get feedback, or you really feel they may suck this year?
No, I actually wasn't being hyperbolic at all. This team is a disaster. I'm sure you've seen Joey Gallo for the first 9 games of the season, and Garrett Cole, and it's
he's doing terrible so far.
Yeah, it's all bad. So
normally I'm a glasses half empty kind of guy, but I'm going to try to be optimistic when you have the money and capital they have, and eventually in a couple of months of trading deadline, I'd like to hope they could at least be in the running in how the MLB is doing their playoff structure now, which is more liberalized. But we will see. It'll play out.
Yeah. I'm not as optimistic. No.
Let's talk a little bit about what's going on with interest rates. So we've had a couple of rate hikes so far. It's believed by experts, which means it'll probably be totally the opposite, that we'll have 6 or 7. Is that baked in? Is it not baked in? And really, and I'm asking too many questions at once, but why does that ever stop me? With inflation so high, how can they keep on hiking?
In terms of the number of hikes, if you look at these Fed funds, they're trading around 97.5, which prices in 2.5 Fed funds by the end of the year. So you're looking at like 9 more 25 basis point hikes. You're looking at 3 50 basis point hikes in a row, but it just 2.5 is where the market expects Fed funds to be by the end of the year. And a lot of people say, well, what if we have a recession? What if this happens? What if that happens? I mean, just leave all that out. And that's probably where Fed funds is going to be by the end of the year. It's not enough to do anything about inflation. If you're really serious about stopping inflation, you have to raise Fed funds above the rate of inflation, like we did in the 70s and 80s, which would mean taking Fed funds up to 10%. If you're really serious about stopping inflation. So what the Fed is going to do here, they don't want to cause a recession. So they're going to look behind door number 3, which is basically the middle path, where they're going to hike sort of an average amount, and we're going to get the worst of both worlds. Inflation will continue to go higher, maybe not as quickly, and we're going to get slower economic growth and maybe not a serious recession. But inflation is all about psychology. It's 100% psychology. And we reversed from a deflationary psychology to an inflationary psychology sometime between March and May of 2020. Now people, because they expect price increases, they act in a way that actually cause prices to go up. And it's a vicious circle. And in order to break the psychology, you have to raise interest rates a huge amount, and they're not willing to do it. And if you look at the dot plot for the Fed in the last FOMC meeting, the dot plot, the highest dot on the plot was 3.5%. And that's the most extreme FOMC member says that the highest that Fed funds will be over the next 2 years is 3.5%. And yet they're forecasting that in 2024, inflation will be 2.6%. So what they're implicitly saying is that we're not going to do enough about inflation, and yet we expect inflation to come down. So what they're saying is they actually still believe that inflation is transitory and that it was an exogenous shock and it's going to come down on its own. They still believe that.
that is shocking. Probably a good part of our conversation is going to be relative to inflation. I do like to bounce around, so we'll come back to it. There may be also some audience interactivity relative to that. Part of my thought on that, and this applies unfortunately to public companies that are very short-sighted relative to quarterly reports, a lot of CEOs are very talented, but their timeline in terms of how they're judged, how they're compensated, and effectively their job is very, very short-sighted. How I'm going to relate that to what you just said relative to politics, the presidency, the upcoming midterms later. This is not about what's going to be great 2 years from now or 4 years from now. This is about how can we basically stop a total shit show, a recession that's going to cause us to lose political clout and power for those in power now. Where am I wrong, if I am?
You're not wrong. I mean, I guess the one thing I would say is that nobody's going to do anything about inflation until the pain of inflation becomes worse than the pain of recession. when inflation gets bad enough that we say, okay, we'd actually rather have a recession, that's when they'll do something about it, not before. So,
but I make the argument, and putting on my family office association hat and who I deal with, that for the kind of families that have the wealth to create a family office, they're buying homes in Miami and Malibu. They're buying more, whatever, crypto and stocks, things that at least were going up in value. They're buying art. There's inflationary relative to certain assets. Could I argue for them, true inflation might be 20 or 30%, maybe more?
yeah, I think we're pretty close already. Like if you look at the shadow stats guy, John Williams, like he's saying, and I can't verify this, but he's saying that if you measured inflation the way we measured it in 1980, that actual inflation right now is about 17%. And what's interesting is that, if you look at the definition of hyperinflation, some people say it's 20%, some people say it's 50%, but we're not too far away. And if you were talking about hyperinflation in 2011, back when gold got to 1900 and it was the European debt crisis and, the US was doing QE, the Fed was doing QE, like, you were sort of a tinfoil hat guy if you talked about hyperinflation. And now I don't think it's really conspiracy theory to be talking about that. Like we're actually kind of getting close and the psychology is present. The conditions are present for that to happen.
Why don't we continue upon a path that will probably get us in trouble, but that's never stopped my shadow bans before on politics. I believe I'm reading from one of your tweets from relatively recently. If things continue on their current path, we are headed for perhaps 10 or 20 years of Republican governance. I'm assuming you feel that the current administration is not necessarily doing such a great job, but you have some concerns over perhaps the past president and what things could look like at the next presidential election. If you could expand on that.
I can expand on it a little bit. I mean, basically what I'm seeing is that the current administration is becoming more and more unpopular by the day. I think Biden's last approval number was 33% or something like that. And what's interesting about this administration is that they're not responsive to feedback. Like if you looked at Clinton in 1994 and the rebuke that he got from the voters at the midterm elections, there was a huge course correction over the next 6 years of Clinton's presidency. And it was also true of Obama in 2010. There was a big course correction. And this administration, whether it's Biden or his representatives, whether it's Ron Klain or Susan Rice, they keep doubling down on these policies.
Yes.
And so instead of being responsive to the feedback, they're ignoring the feedback. And, 6 months ago, people were saying that the election was going to be a wipeout in 2022. Like it's really going to be a wipeout. So,
I mean, maybe on some things I am a glasses, per my perspective, half empty kind of guy. But if you would have asked me 6 to 8 months ago to make a prediction on the election, I just look at the numbers, look at the number of people that are Democratic versus Republican. Now, yes, I know electoral votes and that system kind of keeps the potential of being relatively even, at least for now. But you look how demographics are changing in the Southwest and even in Texas, and the young people, for the most part, tend to skew to being very Democratic. It made me wonder months back, do the Republicans really ever have a chance in a foreseeable future? One of the projects I did for a family on assessing sovereign risk was my belief that within a couple of election cycles, I think AOC is going to be the president or someone relatively like her. We could get into a deeper discussion from that per se. And I know we're getting a little off the beaten path, but that's kind of my reputation. Where do you think, it sounds like your perspective is, Angelo, like you might be wrong, like the Republicans may very well be in power sooner rather than later, but I sometimes have a hard time envisioning that. I don't know if the math makes sense to that.
It's really hard to, I mean, you can see with pretty great clarity what's going to happen in November. Like that's not hard to figure out. Once you get out to 2024 or further, there's just too many, it's too many variables. Like it kind of seems like Trump is going to run, but maybe not. If it's not him, then maybe DeSantis. But a lot can happen in the next 3 years. That's an eternity in politics. So I can't make any predictions out that far. So
In one of your other tweets, you defended the fact that things have been, for the most part, somewhat horrific for much of this year, from crypto to stocks to bonds. And like, yeah, like using your words per my perspective, I have a lot of money in cash. And then the argument was, well, is that getting torn away by inflation relative to what you're getting? Why don't I let you respond to that?
yeah, I mean, what a lot of people, I would love for a mathematician to kind of figure this out at some point, but cash has option value, right? So, and I don't really know how to compute that, but let's just say you have a number, you have $1 million in cash. With inflation at 8.5%, you're theoretically losing $85,000 a year because you're not keeping up with inflation. So now, having said that, some of the ways to keep up with inflation, like the stock market, haven't really worked out so well either. But if you have $1 million in cash, you have the option to buy a piece of property, buy a piece of land, buy an apartment building, buy even just toys, cars, and stereo equipment and things that you like,
Right.
take vacations. Like you have the option of doing all these things, and options have value. If you don't have cash, then you have no options. So I think Twitter in particular, just like people in finance, there's this culture of being fully invested all the time. Like I have to be fully invested in order to keep up with inflation. And by the way, the other thing about cash is that it smooths out the volatility of your portfolio. So if you have a 10 or 20% position in cash, it actually smooths out the portfolio volatility, which is a good thing. So I'm a big believer in having cash, even in an inflationary environment. The only way that really changes is if you get to hyperinflationary environment. Let's just say you have 50% inflation, then you really can't have cash. Then you have to be in gold or real estate or something.
Yeah, I mean, very interesting perspective. It seems like the early death of the dollar has been called way too soon. I mean, look at the Dixie, look at some of the things that you spoke about. And probably the bigger question, okay, I guess inevitably that may very well happen, but in the relatively short to intermediate term, which might even be decades, like what's the next thing? What's the alternative? There is no good alternative. Like, I don't see that changing for a long, long time.
No, I agree with you. I'm not one of these experts on the dollar like Luke Groman or people like that, or
Sure.
Brent Johnson. They do a lot more thinking on this than I do. But for a currency to lose its reserve status, a lot of bad things kind of have to happen at the same time, and it's a process that takes place over decades, not instantaneously. I think the smartest thing I ever heard about that, someone said, I don't remember who, but someone said to me that the dollar will lose its reserve currency status when an aircraft carrier is sunk.
That's an interesting perspective.
Yeah.
I had someone on last week, Jason Lowery, who's with the Department of Defense and the Space Agency and an expert on the proof of work within Bitcoin and areas pertaining to a lot of different things relative to government, the military. And those are actually a fair number of topics that were unique that we did cover. But I think that's a really, really good point that you make. I'm always interested in kind of how people who are smart make decisions. One question that I often ask is, I'm assuming when you're looking at whether asset classes or buckets, you probably assign probabilities to various outcomes. I'm assuming that's something that's very, very important. You're going to be wrong, you're going to be right, but hopefully you're mitigating your risk and you're more right than you are wrong. How do you make decisions?
How do I make decisions? Um, you mean in terms of investing, trading, stuff like that, or?
I'm probably skewing to that, but I like to leave it sometimes an open-ended question.
I mean, I make decisions very quickly. Let's put it that way. I'm very decisive, and it's some decisions I make quickly. The decisions that I make slowly have to do with people. Okay, personal relationships. Those decisions I make very slowly and deliberately. But I can be in my office and see a chart and look at it for 10 seconds and immediately pick up the phone and make a trade, like just make a decision that fast. So
So then there are things, whether it's analytics, graphs, whether it's certain people you respect, whether it's metrics and numbers. It would be we could probably spend hours on that. But if you had to maybe pick two or three things that are core to you to help you make those decisions, could you share them, please?
uh gosh, I'm just not that introspective about it. I mean, look, like when it comes to investing, my number one input is sentiment. I mean, as you've seen on Twitter, like I really, I pay. Twitter is invaluable to me because I pay a great deal of attention to what things that people are saying and thinking. And you can tell when sentiment gets hot and when sentiment gets cold. For example, like sentiment around energy is very, very hot right now. And the funny thing is that sentiment about tech, which was very, very hot in 2021, is very cold right now. And you can make decisions based on this stuff. And there's been some attempts to quantify it. So that's my number one input.
Very interesting. We're going to go back a little bit to a core aspect of the conversation that we somewhat led with, and that's inflation. I guess most traditionally defined as the increase in price of goods and services over time. You gave kind of your overview of that and kind of where that likely could be headed and what the Fed or the government could potentially do to offset that. But if I had to ask you to expound, or even if we are headed to some sort of a recession relative to that and the increase of price of goods and services, what do you think we could look at or be like later on this year towards the end of the year?
Well, the one thing I know for sure, I think my highest probability outcome is that long-term interest rates are going to drop a lot in the near future. And this is a very out of consensus view, but I think 10-year interest rates, which almost got to 3%, I think they're going to go to 2.25 and then some. And I think what that is, so you can interpret what that means. I mean, how am I coming to that conclusion? Well, I'm looking at the charts.
Yes.
But if you look at that and say, how do I interpret this? What if I told you that 10-year rates are going to drop 75 basis points, it would probably mean that the market is pricing in a recession. And you say, well, what kind of permutation of the curve would that be? Well, I think that the curve is going to get very inverted. I think you could have 3% on twos and 2% on tens. You could have 100 basis point inversion, which would be pricing in a very serious recession. And I think that recession is likely to arrive probably in 2023. So,
Do you think we could actually have as one of my guests, well, I don't want to say the wrong guest, then he'll be offended, but is it possible that we have a melt up leading into that?
stocks, you mean?
Yes, mainly stocks.
Like you said, that you assign probabilities to everything, and it's certainly possible. My conviction on stocks is pretty low at this point. I think sentiment is kind of neutral. We're in the middle of a range. I think it's certainly possible. Um, it's one thing, if you believe that, if you take as your core thesis that interest rates are going to drop, then it's probably good for long duration tech, which is the highest weight in the indices, which probably means that stocks are going to go up. The other thing is that looking out to 2023, when we were talking about politics, when I cited the examples of 1994 and 2010, those periods of gridlock from 94 to 2000 and 2010 to 2016, stocks went up a huge amount during those periods. Gridlock is very positive for equities. Probably going to be a little bit choppy in the stock market going into the election, but I think once you get past the election, that could actually be pretty positive.
I mean, bringing, I guess, politics to some degree a little into it. We have a global war going on now, the impact on commodities. We have arguably issues with our own government. We have areas of the country like San Francisco that are completely lawless, for lack of a better word. We have high inflation. I could keep on going on and paint a pretty ugly picture. Relative to a recession, per your call next year, could we be into, a very prolonged bad time, or do you think that would be something that within 12 to 18 months we could get out of and look more prosperous?
I don't know. I definitely appreciate the sentiment. Things seem pretty bad if you look at the news, but it's actually, I do want to sort of pivot a little bit and talk about gold, because I think gold is central to this argument. One of the things that we've done, you mentioned the war in Ukraine, and what we've done, which is, I think, a poor decision and made very quickly, by freezing the Russian central bank's assets, their dollar reserves. That sets a pretty dangerous precedent, because what it could potentially do is set up a whole new monetary system where central banks choose to keep reserves in currencies other than the dollar, or maybe even gold, because there's no controls on gold. So I think we could be entering a period of time when central banks are actually on the margin buyers of gold. And I think it could be pretty positive.
Very interesting. I did have one more government question I'm going to do at the back end, but ironically, my next questions were effectively going to be on gold. Here's one of my questions. Very ironic that you happen to bring it up. Is gold a tool for the central bankers?
Well, it's not at the moment, but it should be. It absolutely should be. I'm sort of a hard money guy. Mm-hmm. I wouldn't say I'm quite an Austrian, but I'm in the neighborhood, and it really, like, gold, physical currency dollars should be backed by gold, right? And a lot of times when you tell people this, you say, well, we don't have enough gold at current prices to back every dollar in circulation. And the answer is, well, actually you do. You have enough gold. You just have to revalue it higher to back every dollar.
That's very true.
So instead of gold at $2,000 an ounce, you have gold at $10,000 an ounce. And then you can back every dollar in circulation. That is unlikely to happen in the next 10 years. But I bring it up because, we're still in the very early stages of this inflation. And when people search for solutions of how to fix the inflation, that is one possible solution. It's similar to what Weimar Germany did when they went from Deutschmarks to Rentenmarks, which were backed by land. It was backed by actual physical land. So that could be something that happens 10, 15, 20 years from now. Who knows?
I guess I have to bring up, I was going to save it to a little later, but there is something else that sprung up about 13, 14 years ago that has a limited supply and has been arguably eating at gold's market cap. And of course, that is Bitcoin. Does Bitcoin, we saw, one country so far, others may come on. I don't want to make it a big argument or debate. We could go on for 3 hours on Bitcoin, but what you're saying about gold, could that apply to Bitcoin?
No, I think it absolutely is true. And when you look at crypto in general, like, Bitcoin is the biggest in terms of market cap. I think it's like 60% of crypto is Bitcoin. Bitcoin in the crypto world is gold. Okay. It's yes. very much a store of value. It doesn't serve any other purpose. It doesn't do anything. It's not like all these other blockchains that have utility and they do different things.
100%.
So the way I look at this is, if you go back 2,000 years, what did the financial system look like 2,000 years ago? Well, it was just gold. That's all that people had. And then you fast forward 1,000 years and you start to have debt and you start to have fractional reserve banking. Then you fast forward about 800 years and now you have stocks, you have publicly traded companies, and the financial system gets more and more complex, and gold plays a smaller and smaller role. Well, the same thing is happening in crypto. You have a lot of other cryptocurrencies that do different things. Basically, they're securities, they're stocks and bonds and derivatives and stuff like that. And Bitcoin is gold, and it will play a smaller role in crypto over time. And maybe 30, 40, 50 years from now, Bitcoin is 1% of the financial system, just like gold is today.
I think that's a very accurate assessment of where things could be headed. And that's not a negative on Bitcoin at all, by the way. Maximalists don't get mad at me. If anything, it's a little bit of a positive outlook, but relative to how other developments are occurring. Back to gold, does gold cause or contribute to war?
Oh, I don't think so at all. I think it contributes to peace.
Would you want to expand?
Well, you can't inflate gold. And one of the things that leads to war is inflation. Inflation leads to war, which leads to all kinds of consequences, which leads to the destruction of civilization. Almost always it starts with inflation. With gold, you can't have inflation. With gold, I think you have peace.
Interesting. And of course, the majority of listeners are active allocators and investors, and some of them, my core audience at Family Office Association, are significant $100 million plus families. They're going to want me to ask you, what do you think the price of gold is going to be by the end of the year?
Well, the end of the year is, I guess, 8 months from now. If you asked me at the time of the Ukraine war, during the invasion, when gold ran up to 2060, I would have told you that it would have been 2,500 by the end of the year. That's looking less likely. I still think it's going to be higher than where it is. If I were to guess, maybe 2,200, 2,300. But I think that's entirely possible.
And going back to family offices, if you're looking at significant investor families with $100 million, let's make it easy, let's call it even liquid. What percentage of their allocation should they be allocating to gold? And could it be an ETF, or should it be actual ownership? Is it 1%, 5%, more?
Well, I'm not. So first of all, I'm a former ETF trader, and I was an ETF trader in 2005 when the first gold ETF was launched. And there were some people from the World Gold Council and State Street that came by the office, and they presented us with a bunch of documents to sign up as authorized participants for the ETF. And I read through all the documents, and I had to be satisfied that this was safe and secure, that we could sign up as authorized participants. So I've probably done more work on the gold ETF than anyone else. I think there is an argument to be made for holding a little bit of physical, but physical is not convenient and also very expensive to transact in. In terms of liquidity and being able to take a position very quickly, I mean, there's almost infinite liquidity in GLD and gold futures and stuff like that. So if you were to have a 10% position as a family office, you could have 9% in the ETF and 1% in the physical.
And like earlier from a tweet that I noted that you're pretty active in cash. Would you recommend, and again, cash, of course, being a variety of factors, literally cash, treasuries, et cetera, CDs. Do you think for a family office that could be as high as 10 or 20%, or you say more?
No, definitely not more. I think 10% is a good number. Yeah.
Okay, interesting. Let's switch over to another commodity, and one that has gotten a lot of attention lately in the last couple of months, and that's oil. And how do you think, relative to the war that's going on, relative to the fluctuation in pricing, arguably potentially government controls, where do you think we're headed with oil between now and the end of the year?
Oil is probably going to go higher. How much, I don't know. The problem is that the cost of capital for energy firms has been raised to the point that any new exploration or production is prohibitive until you get to oil prices that are much higher than here. So it's going to take, the old saying about oil is that high prices are the cure for high prices. And that's actually it's not working today. Like, that mechanism is broken down. I mean, it does work eventually. If oil got to $200, then yeah, like, we would be drilling holes in the ground everywhere. But I think oil has to get up to probably about 130 or 140 before high prices start becoming the cure for high prices.
Yeah. So if you had to put a benchmark on a barrel of oil by the end of the year, what do you think it could be for the range?
I think it could be 130, 140. I do. Yeah.
Okay.
And I don't have a position in that. I don't have any stake in that at all.
And another commodity that certainly with the Russian-Ukraine war, 2 of the 3, along with the US would be the third, are the largest producers of wheat. I don't know if that's a commodity that you follow closely or have an opinion on, but what do you think could happen there?
Well, if you look at the chart, wheat went up to about $13 a bushel. It's settled in around $10 or $11 a bushel. I want to say, I'm going to get the number wrong, but I want to say that Russia and Ukraine both contribute about 14% to global wheat supplies. I mean, honestly, I think that has been priced in. I think that was priced in very quickly after the invasion. So I don't see $15 or $20 wheat. I don't think that's going to happen.
The next question actually came in from one of the participants. I think it's a self-explaining answer, but it's a little comical. So let me ask it. If the US stock market and housing market went down by 50% and stayed down, what would happen to the US economy? It's not going to be a good answer, but what do you think, Jared?
Well, so that's only happened really 4 times in history. It happened in 1929 and 1974 and 2000 and 2008. So it's only happened 4 times. In 2000 was a little bit of an anomaly, but in the other 3 cases, you had depression or near depression circumstances. In 1974, stocks came back pretty quickly. They actually, in the grand scheme of things, they came back pretty quickly in 2008 too. But if you had a stock market that went down 50% and stayed down, really what that does is it crushes investor psychology and risk taking, and it crushes it for an entire generation. I mean, we kind of remember, talking to our grandparents. I assume we're pretty close to the same age, and our grandparents were born in the 1910s, the greatest generation, and they were coming of age in the 1930s during the Depression. And they had very different attitudes toward risk and spending money than other generations. So the biggest effect of stocks going into a 50% bear market and staying down is really the generational effects and attitudes towards risk over a long period of time.
Interesting. We'll switch over, although you did give a bit of an opinion on it a while back relative to stocks. I mean, outside of, I guess, broadly cash, probably ownership of public equities are among the most common holdings that investors are going to have. I could simplify it and put it into a growth and value bucket. I personally have an opinion relative to value investing that it's probably different than a lot of people. Every investment I make, I hope, is a long-term value investment. Oh, sure, it's good if the metrics make sense and I'm getting a discount. But value investors that are hardcore, that have followed that decade after decade, I don't know if that's been the greatest strategy they could follow. But you sounded a little bit down relative, at least in the shorter term, on stocks. But why don't I let you give your opinion?
Well, let me talk about value. So value is super interesting. I've actually done a little bit of work on this, and the time to invest in growth stocks is when real interest rates are going down. And the time to invest in value stocks are when real interest rates are going up, right? So right now we're in a period of time where real interest rates are actually going up. They're negative. They're still like, negative 6 or 7%, but they are going up. And if you look at the performance of value over growth over the last couple of months, it actually hasn't been that bad. So if you believe that the Fed does have the willingness to hike interest rates a lot, then and you think interest rates are going higher, then that would actually be a good environment for value stocks. It's when it's when you have real interest rates that are falling, then you want to buy tech stocks and crypto and SPACs and Kathy Wood's fund and all that stuff. So
I like how you threw in SPACs, actually.
yeah.
Uh, let's talk a little. Well, I can't really call it fangs anymore, right? Because Facebook is now Meta, but everyone knows what I mean. And we'll throw in Microsoft and Tesla since that's been the way to do it. It's probably one of the most common questions I asked investment pundits in terms of which one of those seven. I'm assuming it will look different what we consider a top seven in 10 years. Which one do you think is likely to fall out of that lexicon they're held to now, and why?
Well, the interesting thing about the Fangs is that everybody kind of thought that they moved as a marching band. They all went up together and they would all go down together. But that actually hasn't been the case. Like Facebook kind of went down idiosyncratically, and Netflix went down idiosyncratically. And in terms of the other ones, like they're not going down, but valuations continue to compress and they get cheaper and cheaper. Like Google in particular, like Google, like its earnings are growing at 20 to 30% a year, but the valuations just keep going down. So I don't think the answer is like which one's going to crash. I just think you're going to see a lot of valuation compression in those names over the next 5 years.
And what kind of industry do you think could rise and make it into that even top 10, but let's whatever say top seven? Is there something around the corner on biotech, AI, on longevity? It seems like something on the health front probably is brewing somewhere.
Well, it's funny because if you go back to 2008, the biggest stock in the S&P 500 was ExxonMobil, and it
Yes.
was a $500 billion market cap. It's possible, though not likely. It's not very likely that energy companies are going to have $1 trillion market caps. But you could see market caps on energy companies to go back up into that 500 billion range and become large stocks again over the next couple of years.
Interesting. And it is amazing when you look at that list of the top companies over the last 20 years. It's kind of shocking, like how it's changed. I mean, Facebook wasn't even around. Like it's amazing. Probably the most common answer I get if the audience is interested is that Netflix would be one that may not make it. And by the way, the more people say that, the more likely, probably contrarian, it's probably likely to be wrong. The one I think that's been the most consistent, I kind of already hinted at it, that has been on that list for decade after decade, I think after decade, has been Microsoft. And with their leadership and what they're doing now in the metaverse, I have no reason to believe that may not continue for 10 more years.
Yeah, I don't know a lot about Microsoft. It's funny because actually this doesn't have anything to do with your question, but I heard something really interesting a couple of months ago. Steve Ballmer is worth about 100 billion and owns the LA Clippers.
Of course.
Bill Gates is worth 130 billion, something like that. But Bill Gates, in 2002, 3, 4, 5, sold a lot of Microsoft stock. He sold a lot of Microsoft stock. If he had held on to it, he would now be worth $500 billion.
Oh my God, I never heard that stat before.
Yeah.
That's a good one.
Yeah. And
Wow.
but whereas Ballmer didn't sell that much stock, and he almost has the same worth as Bill Gates.
That's actually pretty, I'm going to remember that. That is pretty amazing. It may not be as much your bailiwick, but sometimes it's good to get opinions in that perspective. Many family offices are active in what I would say are broadly private companies and maybe earlier stage like VC. Many of them are LPs and some of them direct investors. I hinted at actually two areas already: biotech, AI, longevity. Maybe I'll throw in blockchain, climate change. There does appear to be up and coming trends that are accelerating and likely will make their way into areas that the most successful families are going to be active allocators to.
Yeah. I mean, I think that we are entering a period of time when the pace of innovation is going to slow down significantly. We were seeing huge amounts of innovation 2017, 18, 19, 20, 21. And now that we have inflation and war and some pretty nasty politics, we'll continue to have innovation, but I think it's going to be much slower than it was in years past.
It's always an impossible question, which means I have to ask it. Let's take a truly significant Forbes 400 level family, $1 billion plus, has a traditional family office. They're going to be with, I want to, rule number one, don't lose money. All right. And rule number two, remember rule number one. I have a bit of a problem with that. One, families consume, some more than others. So that's a drain on it. Taxes. And what did I say earlier about what's the true inflation for families of that level? It may be 15, 20, 25%, 30%. So even a family allocating and investing overly conservative, getting 10%, coupled with the other factors that I mentioned, they may be losing purchasing power. They're not going to notice it in 1, 2, 3, probably not even 5 or 10 years, but over decades, it's slow. Do you generally believe, and I know it's more my area, that family offices actually invest too conservatively?
I think they invest conservatively, but I think it's totally appropriate. I think it's absolutely appropriate. And the 10% number you gave out is actually kind of high.
Yeah, I was going to actually say that too.
Yeah, it's actually more like 6%.
Being generous.
But if you were to take these, if you had $1 billion and you were to, be in 20% equities and 20% fixed income and 10% cash and 10% gold and some alternatives and real estate and stuff like that. I mean, it's
save a little love for crypto.
yeah, a little crypto. But that's a portfolio that's going to get you 6 or 7% a year. And if you're losing purchasing power, I don't think, the attitude that very wealthy people in family offices have, where don't lose money. I think that's most important. And if you're losing 1 or 2% to purchasing power every year, then it's really not the end of the world.
Kind of that position this question before, maybe I could slightly twist it around. I'm being really negative again. Stock market collapses 50%. Bitcoin falls 50%. So I changed it from real estate this time. Is that actually, would you look at that? Would you look at that as being, okay, this is an opportunity to buy at a steep discount?
Yeah, I mean, that's why the cash. Earlier in the discussion, I talked
Yes.
about the option value of cash, and this phenomenon where people feel like they have to be fully invested all the time. I mean, when you're going to buy something cheap, I talk about this. I call it the 3 C's. You have to have courage, conviction, and capital. Okay. So courage is, if stocks are down 50%, it's going to feel terrible to buy stocks. You're not going to be in the mood to buy stocks, so you have to have courage. Conviction is you need to have done your research, and capital means you actually have the cash to do it. Not many people have been able to take advantage of these big downturns we've had over the years because they haven't had the dry powder.
Yes, that's probably a pretty good way to put it. Could you see central banks lowering rates to zero to stimulate the economy if a collapse of that level that I described, the 40, 50% were to happen? And here we go again, even you're saying a recession next year. Is it inevitable that we're going to keep on adding to the deficit?
Well, I'll answer the second question first. The fiscal picture is going to get a lot better after the midterms. I mean, if you look at Obama's presidency, the first 08, 09, 2010, Obama was running 1.6, $1.8 trillion deficits. They were 11, 12% of GDP. And then after the midterms, they came down to about 4% of GDP. And by the end of his presidency, they were about 2% of GDP. So last year in 2021, we ran a $3 trillion deficit. That's going to be significantly less in 23 and 24. My guess is you'll have deficits in the 500 billion to $1 trillion range. It's going to be much, much smaller. We're also collecting a huge amount of revenue. tax revenues are going to be massive this year. So that also plays into it. I forgot the other question.
Well, it went a little bit back. That was more on the deficit side, but
Okay.
relative to interest rates and what the government will do, reversing that if things were to really go to hell in a handbasket.
Yeah, I mean, I tell you what, if let's say the Fed raises rates to 2%, and then we get a recession and they have to cut rates again, but
Right.
you have inflation at 10%. Like I mean, people are saying that the Fed is in a pickle now. They'll be even more in a pickle. I really can't predict what they would do in that situation.
And my audience knows, and I would be remiss if I didn't ask, although you did answer relative to Bitcoin, a little bit relative to crypto. So you did mention that Bitcoin being, if nothing else, and maybe actually that is its purpose, it really is nothing but a store of value, but other platforms, Ethereum, Solana, they're actually building things on it, potentially from DeFi to, let's broadly go with NFTs, to other utilities that are happening. When did you start to say, okay, I may not be the biggest fan of this, but maybe there is an opportunity to learn more about it, and for families that are significant, maybe start with under 1% and work their way up to maybe 1 to 5%? Could you see that being a logical play?
Yeah. Excuse me, I'm getting over a cold. I don't I really am not a technologically sophisticated person. It was I've invested in crypto twice. I bought Bitcoin in 2019 and I sold it in 2021. And then last year I bought a basket of other altcoins.
Mhm.
When I started seeing that the big venture VC firms were doing investments in this stuff, really the smartest people in Silicon Valley, I said, okay, there's got to be something to this. And I don't spend a whole lot of time like watching the price of Bitcoin every day or Ethereum or Solana or anything else. For me, it's a 10-year trade. It's a 10-year investment, and I don't look at it, and hopefully it's worth something a lot more in 10 years.
Could you see a point when the Bitcoin market cap equals gold, whether it rising enough or whether gold coming down?
Gosh, I don't think so, actually. I mean, anything can happen, but I guess Bitcoin would have to get to about 250,000 for that to happen. I
A
mean,
lot more than it is now, more than that,
yeah,
I believe, actually.
yeah, yeah. So, no, I don't, not definitely not in the next 5 years. Let's put it that way.
One of the areas, and it's probably a little off topic, but I like to talk to smart people and get their opinion on it, even if it's not something that you're given a lot of focus on. Some of the consulting work I do working with families is addressing risk that they have. I like to borrow from Donald Rumsfeld. There's the known knowns and the unknown unknowns, assessing vulnerability and mitigating the risk. If something may happen, but the consequences are relatively minor, okay, that gets a little bit of my attention, but it's not that bad. But if something has a small chance to happen, even 1 or 2%, but it could be devastating. I mean, maybe I lose 80, 90%. That's probably going to keep me up at night. How would you relate that relative to what you do, looking at charts, looking at the economy, and relative to investing?
Yeah.
Not a great question. I'm sorry.
No, that's okay. So, I look, I don't have family office kind of wealth, but I do have some wealth, and I sure don't want to lose it. So I kind of do the don't lose money thing. Um, I I don't always have a hedge. It's two things. It's two things. Number one is having a hedge, and number two is portfolio construction. Now, diversification in and of itself is not insurance against a drawdown, because what happens is that when you have a bear market, all the correlations go to one, and you may think you're diversified, but you're actually not. And like diversification is no defense against a drawdown, but diversification across asset classes is. So if you have stocks, bonds, gold, cash, real estate alternatives, stuff like that, if you're diversified across asset classes, that's pretty good insurance against a drawdown. The other thing is having hedges in the form of options. And, sometimes hedges are cheap, sometimes they're expensive. I like to take advantage of them when they're cheap. When they're expensive, they're usually not worth it. So
True. And that's been, actually, I was going to bring up someone like, like Nassim Taleb, who certainly we're all big fans of his work in anti-fragile, which, by the way, being anti-fragile, I've dealt with the wealthiest families, multi-billion, sometimes well into 50 to 100 billion. I don't know anyone who's anti-fragile. You don't want to be fragile, per his definition. You probably hope to be resilient. That's his next level up, maybe ultra resilient, my own word. But striving to be anti-fragile, which would almost be profiting from when things go to hell in a handbasket. It's interesting. And I, probably spend multiple hours a day on it. And there really is no one perfect answer. Related to that, and I even hinted at it with some political type questions earlier. I mean, we saw what happened in Canada, a very democratic country, with Trudeau and the truck drivers, with the threat, if nothing else, of we know who you are. We know your bank accounts and your crypto exchanges because you don't have it on a private wallet, and we may freeze them. And although it's going to be controversial what I'm going to say next, the US and the EU relative to, let's say, Russian oligarchs, now I'm a libertarian. I do not like the government putting their hands in people's wallet like that. And this all goes to the snowball effect of what could go wrong. Again, I don't quite know where my question is in there, but I'd love your opinion.
Okay, well, there's a couple things. I mean, you mentioned Nassim, and he's an advisor for Universa, which is run by Mark Spitznagel. Yeah,
correct.
So I'm sure you're familiar with that because his tail risk strategies are really, really good for family offices. Because the way Nassim puts it, you want to invest in things that gain from disorder. So you have to you have to think about what types of things gain from disorder. So tail risk funds are great. In terms of asset freezes, stuff like that. I mean, we talked about physical gold earlier. It's I recommended having a 1% allocation to it. And the attraction of physical gold is that it's totally off the grid. I mean, even Bitcoin is not off the grid. Like, even if you have it, it's like it's traceable. That's really the attraction of physical gold. So, I mean, if you have $1 billion and you have, $10 million in physical gold and shit hits the fan, then at least you have $10 million in physical gold that you can move around with you,
until someone wants to go and take that from you because they know you have it. That's a whole other subject relative to my belief on compounds, community, and that's part of the work I do. I'm going to brag about my catchy title with families. How do you like this one, Jared? Disaster prep for billionaires. Oh, it's sorely needed. It's one of the most common requests that I get from those families. What's the best investment advice that you ever received?
So I don't know if this was advice from a specific person, but it was really a bunch of people, and this took place, I want to say, between 2013 and 2017. But prior to that, I very much had a trader mentality. So I bought stuff that was down and I sold stuff that was up, and I was very much a mean reversion investor trader. And then I started to, I know who it was. It was Salem Abraham. Do you know who he is?
No.
So he's a well-known CTA out in Texas. Just a mathematically driven CTA. And he is a trend follower. And he basically taught me how to follow trends and how to stay in trends and add to winning positions over time. And that's made me a much, much better investor. And really, I owe it to him. And he's the nicest guy in the world.
Wow. No, that's good insight. I'm going to have to learn more about that and look him up as well. Is intrinsic value, when mentioned in financial markets, bullshit?
I think it's half bullshit.
Okay.
I do. Ultimately, if you have, especially like in distressed situations, if you're looking at a distressed equity and the market cap is 40 billion and this company has cash of 60 billion, and you can figure out the burn rate, then like there is an intrinsic value there. But I think people apply that term too broadly, and they try to assign intrinsic value to intangible assets and goodwill and vaporware and stuff that doesn't have any tangible value. So I think that's where people get carried away with it. But like a lot of times, you hear this in trading. You say, well, wheat is at $6 a bushel, and this is the lowest it's been, so it can't go any lower. Well, of course it can go lower. It can always go to low. I mean, it can, as we saw with oil in 2020,
yeah, 2 hours or whatever.
It went negative,
Yeah.
So
it's kind of a related question. We hinted at it earlier as well. Is the stock market a beauty contest?
I think that's a pretty good analogy, the Keynes analogy. Yeah, the funny thing about beauty contests is my wife and I, we watch every single beauty pageant. We watch Miss USA and Miss America and Miss Universe. And I sit there on the couch and I do the Keynes game where I say, okay, she's going to be in the top 5 and she's going to be in the top 5 and she's going to be in the top 5, because I try to pick not the ones that I like the most, but the ones I think the judges will like the most. And inevitably I can pick 3 or 4 out of the top 5. So wow. I actually do it pretty well with actual beauty contests. I don't do it as well with stocks.
Well, I asked you the right question then to ask that question too. Back somewhat to inflation, but a little different perspective. Are businesses with pricing power a hedge for inflation?
Oh yeah, absolutely. Yeah, pull up a chart of Coke. I don't know if you've seen a chart of Coke lately. It's on the 52-week highs. Like it's Coke, you look at these big consumer staples companies and you're like, well, they have all this inflation pressure on their inputs. And I'm like, yes, but they have pricing power. They have huge amounts of pricing power. Coke, Procter and Gamble, Pepsi, General Mills. I don't know if you've seen a chart of General Mills lately. General Mills is on the highs, and everybody knows that cereal sucks. It's bad for you. It's all carbs, and wheat prices have gone straight up, and the chart is on the highs because they have pricing power.
It's always a bit of a sense. Yes, that one I agree with on inflation hedge. But in general, I always chuckle a little bit. Well, this is an inflation hedge. Like gold often comes up, farmland. And at different points, if you look at the history, yes. But consistently, I don't know if anything is ever really consistently all the time an inflation hedge. Am I right? Am I wrong? Somewhere in between?
You can actually compute correlations of different assets and different sectors to inflation. And interestingly enough, energy has a 70% correlation to inflation. Energy has the strongest relationship to inflation, and gold is actually much lower. Gold is about 30%.
Yeah, so, I'm not surprised.
Yeah.
Interesting, though. I didn't know that one about from the energy perspective. How about farmland? Do you think broadly, I mean, Bill Gates is buying a truckload of farmland. Is that a great hedge for inflation?
I mean, land is always great. I actually bought some land, not farmland, but I bought some land a year and a half ago, and it's more than doubled in a year and a half. Land is like 100%. Like that's probably the number one asset you would want to own if you're a family office, for sure. Yeah.
Although if it's just land in and of itself, that may give a sense of security. There may be timber and other natural resources to monetize, for lack of a better word. And again, you could always build. But in theory, you're putting money to an asset that may not be generating income, which brings back the bigger picture of real estate that we didn't even really get into. That probably is among the most common holdings of a family. And I guess you're trading off liquidity for a real asset, opportunity for leverage, easily understood, tax benefits. I mean, real estate could be very attractive.
Yeah, and also very, very sensitive to inflation. And the funny thing is that when you're talking about residential real estate, you know, mortgage rates went from 2.65 to 5% in the span of 6 months. So a lot of people are predicting, oh, the housing market's going to crash because interest rates went up. The residential housing market has not slowed down at all. It is not slowed down at all. Where I live here in South Carolina, it's interesting because the real estate brokers are actually bored because they're not doing transactions because there's just absolutely no inventory. It's just bid, no offer.
You know, ironically, I was going to bring that up. I didn't know you were based in South Carolina. I'll be doing roundtables in areas that I've never done before. One of them is Nashville, Tennessee. We're doing a dinner program in May, and I would love to go back. I've been to Kiawah Island twice, but to Charleston in South Carolina, which I think is just utterly such a charming and beautiful city. Now, I don't like the state taxes where you are, but other than that, it has so many charms to it.
Yeah, they're actually talking about lowering the state taxes. They're going to lower it from 7% to 5.7%. So it's going to get better.
That does matter.
Yeah.
The president's working order on financial markets from 1989 helps keep the stock market from wild swings. I'm assuming in theory either way. I suppose that's needed. Whether it works or not is debatable, but let's say it does. Here's a little bit of my concern. Is that manipulating the market?
A lot of people call this the plunge protection team. If you go back to like 17, 18, 19, there were all these conspiracy theories on Twitter about the PPT. You had the market would like ramp the last half hour of every day, and everyone would say, oh, the PPT's in there. I mean, I hate conspiracy theories. All this is a group of finance people to like talk about markets when things get a little choppy. It's really all this is when they convene this working group. It's just to sit down and talk about what to do. So there's not some guy in a closet with a futures terminal buying e-minis, like trying to get the market up,
We'll go quick round robin and wrap it up the next 5 or 7 minutes. Why are major stock indices so hard to beat? Now, it does look like things are turning somewhat to more active management and maybe less so on the family office side. But in general, should people be mainly invested like you have the background in ETFs? They're liquid, they're cost effective, and most active managers fall short.
Yeah, this is this isn't really good for a round robin answer, but it's basically 50% of all assets under management now are passive. It's 50% passive and 50% active. And if you go back to 1996, it was 2% passive, 98% active.
Wow. That's startling.
The math behind this, basically, you would think that the more people that invest in passive, the easier it would get to pick stocks, but it's actually the other way around. The more people you have in passive, the harder it is to pick stocks. Japan is actually 70% passive, and nobody can beat the index in Japan. So it's just kind of this freight train that's just keeps rolling, and there's nothing you can do about it.
Interesting perspective. Maybe back a little bit to inflation and store value, although I guess theoretically different things. Why aren't baseball cards, Pokemon cards, and other things, one, relatively a store of value? My part two, and this has come out in the wash a little bit it might have been Michael Jordan's basketball card, but there are professional investors that are basically manipulating the markets. And I know that came out of nowhere and it may not appear too related to part one, but I do find illiquid, inefficient markets very interesting.
Yeah, I mean, collectibles continue to do well. Collectibles have been terrific. Comic books, baseball cards, basketball cards, art. I mean, art is sort of a more highbrow collectible. Yeah, like I don't really have much in the way of collectibles. But like you said, they're liquid and they're inefficient. And what it kind of reminds me of is private coins. When you have a coin dealer and you walk in there and you want to buy some bullion, you want to buy some American Eagle, silver, gold, stuff like that. And he says, well, how about these private coins, these private mints? And they're trading at like a 20% premium, and you buy them and then you find that they're totally illiquid and you can't sell them, and then you die and the coin dealer buys them back at the estate sale. Like, so like, I just don't mess around with this stuff.
That makes sense. Is keeping money in foreign savings accounts or CDs, is that a hedge against the dollar collapse?
So if you have as you know, if you have a foreign savings account, you have to file an FBAR.
Of course.
Yeah, which I did that for a couple of years. I didn't really enjoy it.
Not
So
too fun.
yeah, actually, you know what I thought about doing is I thought about going to Switzerland and getting $1 million in cash in 1,000 Swiss franc notes and just putting them in a safe deposit box in Zurich, and just having the currency in a safe deposit box. Just because I don't, it's on. You don't have to open the FBAR anyway. I was just thinking about that. So
Yeah, that's an interesting perspective. And part of that work I do, I know I try to be a little funny with it, but disaster prep for billionaires. And I was serious about that. I used to call it sovereign risk assessment, but that was too boring. I am a big fan of Switzerland. I do think francs are interesting. Again, we could save that discussion for a different time, but why don't I go with, I broadly think you're on the right track. I think my final question, and you've come around somewhat to crypto, if we could go with that. We both wear body art. I have one that represents, several actually, that represents what I'm going to bring up next. Do you have an opinion on NFTs?
I think NFTs are an incredible technology. See, you have to keep in mind I'm a music freak.
I remember that.
Yes. So I have collected music my whole life, and I have a lot of opinions about when music went digital and how it destroyed the music industry. But the one way you can restore the music industry to where it was before is through NFTs and creating property rights for digital art. Because yes, like there's been no property rights for digital art at all, whether it's digital music or actual digital art. And I think this is the greatest innovation of all time. So
Jared, I'm so delighted to hear this. I want to hear you or read you write about more this on Twitter. So my audience knows I'm very much at the forefront of NFTs. Yes, I know most of you in more traditional family office think I'm a little crazy. I promise you it is way more than verifiable JPEGs, quote unquote, digital art. And if it was nothing but digital art, but still verifiable, and there's people that are interested, that would still have value. It is so much more than that in the world of music, in the world of fractional ownership. We're going to see our homes, our residences be NFTs one day. It really brings the promise of the blockchain to life and will lead into the metaverse in a variety of different ways. Not the discussion for that today, but I'm glad to see we have some similar feelings on that. We'll save that maybe for a deeper discussion in round two. It's been a pleasure, Jared, to have you on. And again, that's Jared Dillian, Dillian. I highly recommend going to Twitter and going to Daily Dirt Nap and subscribing. And Jared, besides that great free Twitter and guidance that you give, maybe talk a little bit about how investors and families, institutional investors, whatever, could take it a step further and subscribe to your more personal services.
yeah, so I do a bunch of newsletters. Some of them are retail, but the one I do for institutional and high net worth people is called the Daily Dirt Nap. Comes out every day. It's 3 pages a day. It's a really of literary quality. It's the best written newsletter that you will find. I have experience as an ETF trader. I traded macro prop at Lehman. So it is a macro top-down newsletter. It's very funny. It's very engaging. You can go to dailydirtnap.com, hit the subscribe button, send me an email, and we'll get you set up.
Well, thank you. And I'm a big fan that you all do that. Jared's work is great. Besides really great insight and well-written, he also adds a little bit of a comical edge to it, which I think makes it a fun read, for lack of a better word. Everyone, I'm Angelo Robles, the host of the Angelo Robles podcast, founder of Family Office Association, very active on social media. I'm Angelo Robles Meta, as in Metaverse, on Instagram. Probably my main platform for many of you is YouTube, and I'm simply Family Office. I registered that name many, many years ago when YouTube first came out. It means I'm old. I'm also Family Office on Twitter. So please follow. Hopefully I provide good interviews. Forget my insights, but my great guests like Jared and many, many others that I've had on over the years, and learn more about Family Office Association at familyofficeassociation.com. You may want to become a member. Forget me and great speakers. We've had Ray Dalio, Tony Robbins, Peter Thiel, and many others. That's all arguably just icing on the cake. You get to meet other amazing families, investors, some of them newer to wealth, some of them generational, and the opportunity for you to learn from each other, to share information. That's where the real value is. And we're back doing physical events very actively around the world, my digital program. So hopefully we have a lot to offer. You've all been very kind. Thank you to our live audience today. We hope our YouTube audience and podcasting enjoyed it as well. And thank you, Jared, for being a great guest. Look forward to continue to follow you on Twitter and interview you again, perhaps later this year.
Thank you.
My pleasure. Thank you.